everyone. This is Nehal Joshipura, a faculty in finance at Durgadevi Saraf Institute of Management Studies. I will take you through the investment analysis and portfolio management basics. Now, today we'll see the basics of investment process, how this investment process is happening, maybe at the funds level like mutual fund, ETF, hedge funds, or at the individual level where we see a particular portfolio manager, we go to the bank and meet a manager and somebody asks us to do the wealth management or PMS services are provided at the individual level. So, the level could be individual or it could be for the mass. But the process remains the same, and it is really essential and required that we understand who are the participants in this market, how is this market happening, what are the prerequisites or what are the do's and don'ts before we understand what is the discipline, how is this called science, now how has it evolved. So, I'll take you first through the participants in this market, or maybe I can say the stakeholders in portfolio management industry. Who are they? The first one, the most important, is the client. The client could be an individual who's taking the PMS service or investment advice from an advisory, or it could be the mass, like for mutual fund, it's public, general retail investor, that's a mass public. So, that is the client. Then second stakeholder is portfolio manager. Now, this portfolio manager could be a fund manager at mutual fund, or it could be an individual who's assisting other friends and family or the clients with separate accounts. So, this is portfolio manager or the fund manager whose agent on behalf of the client, the portfolio manager advises where to invest or maybe invest on his behalf. And the third category, the third thing which is between these two people is asset classes and markets. Now, what do we mean by asset classes? Asset classes means the broad category of assets in which the choice has to be made. First, which assets to pick up, and secondly, how much to pick up of which. And for this, we need to understand the markets, the A to Z of the markets. So, firstly, let us see the client. What is important about client? What is the client side of investment? The client gives as an input, or essentially I can say when the investment process begins, the client is contacted and he is asked to provide inputs on investment horizon, tax status, or family details, how many dependents, how much money has been already invested, or how much earnings are there, is he a salaried person or a business person, and things like that. Normally, in the organizations like where portfolio management or fund management services are provided to an individual, what they do is they give a questionnaire. They give a questionnaire with the questions related to all these things, like for example, when you see a client who's young enough, a young MBA graduated only 5 years back, having handsome salary and has all forefathers property also which is coming to him. He doesn't have to buy a house or any property for that matter, is a bachelor also. Now, his disposable income could be very high, level of dependence, number of dependents is lower, so he can take more risk compared to the other guy. Maybe his classmate, but has so many dependents, he has so much of responsibility and maybe lesser income also. So, this way we understand the client's details about his investments, income and all, and then looking at this questionnaire, the fund manager can make a judgment about his risk aversion. Now, what is this risk aversion or risk tolerance? That is how much he is afraid of the risk factor, how much risk he can take, and how much he should invest into. This number actually will guide us to decide how much what portion of money should be dedicated to risk-free assets or more secure avenues of investment, and what portion of investment should be dedicated to, should be put into risky assets but more return earning, of course. So, this is the risk aversion or risk tolerance. Now, this level could be both ways. It can be actual or it can be perceived as well. Actual is what we study by putting this questionnaire to the client, giving this questionnaire to the client. Client fills up the questionnaire, we get to know his details, and then we understand, okay, at his level, a level of earnings, at his age, with his kind of dependencies, what sort of risk he can assume. That is one. Secondly, sometimes it can be perceived also, like an individual could be, his income capacity may not be much, his investments may not be much, he may not be inheriting much of property, but he is very enthusiastic about taking the risk. He may be very enthused about getting into stock markets and playing with the bulls and bears. So, this guy has perceived low risk tolerance. I mean, he wants to assume higher risk. This is his perceived risk tolerance or aversion. So, for judging this perceived risk tolerance, what typically is done is, in the same questionnaire, some questions are put up which are from behavioral or psychological sort of questions. Like, for example, when the market is dropping by, let's say 10%, 20% all of a sudden, and what would you do? Now, there are three alternatives. You will invest with the same amount of money. Let's say you have 10,000 rupees of investment. Now, you invest further 10,000 rupees trying to average out your cost of buying, bringing your cost of buying lesser down. So, that is one. Second option could be do nothing, be indifferent, just keep silent, wait and watch. Maybe the market is correcting itself, maybe the market will come back, rebound, or try to study the market. That is the indifference thing. And the third thing could be, maybe I'll be afraid, I'll sell everything that I possess and I'll come out of the market, be out of the market for a while till the time this higher volatility period continues. So, this is the third option. Now, giving such options, you can judge how is the reaction for the same situation, how is the reaction. Is client getting excited looking at the higher risk, or he is afraid looking at the higher risk, or he is indifferent? There are three categories actually theoretically. We divide the individuals into looking at the risk averseness. One is risk averse, the one who is afraid of risk, and we mostly, I mean majority of the people while investing, they will be like that. Second is indifferent, risk indifferent, and the third could be risk lover, the one who embraces the risk wholeheartedly. Gamblers could be like that. But most people in investment category, we assume they have risk averseness, they are risk averse, but of course the level of risk averseness we have to judge over here. So, this is the information which is coming from the client. Now, when we bring this information from client, there is the second category of information which we bring from the markets. We have to now take the inputs from the market. What does the market tell us? Before we get to market, we will see who are the people involved in this thing. Portfolio manager, the second thing in our first slide. So, portfolio manager could be at the institution level. Now, I am talking about the institutional level. Now, I am not talking about the individual level. So, individually you can call it fund manager, you can call it your advisor, investment advisor, but fund level, at the fund level there are three types of funds. There are three major categories of funds, I can say, worldwide. One is the mutual fund. You almost everybody has heard of it, the very developed industry, especially in India. So, what is this mutual fund? Mutual funds, and they are pooling the money from people and then they invest into the markets on behalf of people. They pull small monies from public, and this large money can be managed well. So, the assumption is because this is a large money, they can afford to have higher analytical skills, they can afford to pay higher to the fund managers, to the so-called experts. And second category is pension funds. Who are the pension fund managers? They are again the people collecting money from public but for their pensions. So here the safety is probably more important. And the third category is hedge fund. Hedge funds cater to mainly HNI clients, high net worth individuals, and there the safety may not be as important, but yes, return has to be tempting. So high return, high risk, that is the game over with the hedge funds. So if I differentiate in nutshell, I can say mutual funds, they cater to mass, that is retail investor is their audience or their client is retail investor. To this retail investor, what they are serving is not so high return, but yes, moderate risk and moderate return, we can say. And the third category is pension fund, which where they are essentially investing for retail investor, but for a very long term, while mutual fund is investing for medium to long term. So pension funds are essentially for therefore the longer period, they invest for a longer horizon. Hedge funds, they can be short term to medium term, the investors. They want to rip in high profits. So that's and altogether a different ball game. Okay, now how are they regulated? Let's talk about the regulations over here. Pension funds, mutual funds are most regulated ones. Pension fund and hedge funds are not so regulated. Pension funds have to invest typically in all countries, they invest more in safe instruments rather than in volatile equity markets. While hedge funds, they are risk takers, they invest into alternative assets as well apart from equity markets and safer instruments. They are not much interested in safer instruments. They want to earn high return, and that's why they also enter alternative asset categories. We'll elaborate much on alternative asset classes further when we do asset allocation, when we understand what is how asset allocation is done. So these are the fund manager categories from the list regulated hedge funds to regulated mutual fund categories we have seen here. Now the next slide talks about the third stakeholder over here is asset classes and markets, the third thing into the picture. Here asset classes, what do we mean by asset classes? Though I briefed you about it, let me just further elaborate on this. Firstly, we divide all assets into two major categories. One is real assets, the other is financial assets. Real assets are like, for example, real estate, commodities and natural resources for that matter. These are real assets, they are real assets, and financial assets are probably showing a claim on some real assets. They are representing a claim on some real assets. For example, equity and bonds. Equity and bonds are financial assets, they are representing a claim over the assets of a company. So they are financial assets. So we have these two categories, broad categories of assets. So one has to maybe decide how much money to be kept into, invested into real assets, how much money should be invested into financial assets. Again within financial assets class, how much money should be invested into equity market and how much into bond market. So these decisions are to be made, and which we call asset allocation. So that's asset classes, that's what we call asset classes. Again within the asset class also there can be different bifurcations. Like in equity market, we are very familiar with those who are included in the indices like Sensex companies. We talk about Nifty companies, then we talk about A group shares, and then we talk about Z group shares. So these are different categories, again could be there within the asset class, but generally these are the broad asset categories: real estate, commodities, natural resources, stocks, bonds. These are different asset categories per se, the examples of it. There can be more. So mainly we have financial and commodity markets which are different from each other. Commodity markets, it's essentially for real assets, commodity markets and real estate markets, they are connected to real assets, while financial markets, where we see equity market and bond market and derivative market, equity derivative market, they are for financial assets. Now, who are the people playing around in these markets? One is exchanges, stock exchanges, then second is currency markets are there, then we have commodity markets. For commodity again we have separate exchanges, for currency markets we have different players like bankers and forex dealers and all. So we have different people trading in different markets. So that's all about asset classes and markets. Now let's move on to the process. Now let me begin with the process. Once we have taken the input from the client about his risk aversion, his level of tolerance of risk, this input is taken, and that input tells us how much utility he will derive, how much benefit he will derive from which risky proposition in the market. Now once the process begins, it can be top down process or it can be bottom up, and here is the top down approach, wherein first the portfolio manager at a broad level he decides this total amount of money, this total sum of money which he has already decided looking at client's risk aversion. One thing has been decided, that how much money to be kept in risky assets. Now within these risky assets, the asset allocation is done first. Now there are various asset allocation strategies in market. People employ different strategies. At a broad level, certain companies are known for a particular asset allocation strategy. Some companies are doing it little differently. But main purpose is diversification over here. Diversification, if I simply in one sentence, if I summarize this principle of diversification, I can say don't put all your eggs into the same basket. Otherwise you will lose them, of course. So what if you want to derive the benefit of diversification, it's necessary that you invest into different categories, so that if one category goes down, the other category is up at the same time, so that one loss can be covered by the other benefit or something like that. So there, in order to understand, first we look at the diversification benefit. How much is the diversification benefit if I diversify? Can I quantify that? If yes, how much it is? So that is one aspect we look at. Then second is, what are the asset classes available in my market? Maybe I am in a particular country, I will see what are the markets available at this point of time, and of course along with that I must have some views about those particular markets. Let's say in India we have equity market, we have bond market, so I should have some view whether equity market in near future or in the long run will go up or down. If up, how much? How many percentage? Will it beat inflation? Will it not? What is the correlation with the other markets? It is bearing. So we look at the market views over here. They are inputted here, and at the same time the economic indicators, because this is a macro level decision. We look at all the macro informations, and you also may require to make a decision whether to invest only in domestic asset classes or invest globally, whether to make it a global portfolio investing into different countries, or to make it a domestic portfolio. So these decisions are made. So people decide firstly whether it has to be a global versus domestic, and then again within that particular country what asset classes will be eligible for, how many percentage of fund allocation, how much money should be put into equity market, how much money should be kept into debt market, and of course the other asset classes. The other asset classes include like commodities, or it could be maybe tea gardens, growing tea, coffee, like things like that. These we call alternative assets, which are other than mainstream asset classes. So they are alternative asset classes. So people may have various strategies they employ. We'll further later on see what are the asset allocation strategies or what they can be. So this is broadly a broad decision on, let's say for example, if I decide this many percentage to be kept into equity market and this many percentage to be kept into bond market. Now let's say within equity market, I'll enter the next step. The next step over here is security selection. Now after asset allocation is already done, we enter the security selection phase. Security selection is then done by taking the inputs about individual securities or industries or sectors. Then you need to have here the views about particular sector or industries and their correlation in between. So you look at the security, like you have seen many people analyzing on TV channels. You open any time CNBC news channels or any business channel for that matter, and you see several guys analyzing the market. Okay, this particular security is good, upside is this, downside is this, and you listen to so many news coming up every day 24/7 on some or the other part of the world. So this is essentially security analysis. Now, how people actually or practically do it? This can be done, basically we broadly call it fundamental analysis. There are two things mainly done in this area. One is fundamental analysis, wherein all the information about a particular company is studied. It can be balance sheet information, it can be profit and loss, I mean the financial statements, and even qualitative information like what is the background of the management persons. So who are the board of directors, who are the promoters, what is their background, whether they have been always successful business people or they are novice startups. So things like that. So there are some qualitative factors and so many quantitative factors about the company performance, past performance, and then studying all this together, putting all these pieces together, solving this jigsaw puzzle, you come up with one word: buy or sell. So that's fundamental analysis. Now using fundamental analysis, maybe I can zero down on a particular company. Yes, this company is good, this company is not good. Now suppose if I say this company is good, buy recommendation is there. Now the next question which arises is, at what level should I buy it? Should I buy it at any price just because it is good? Should I buy it at any time just because it's good? No, there may be a proper time, maybe sometimes a time when it is undervalued, when it is not less than its fair value, the value that it deserves. So this timing part can be taken care of by using technical analysis. Technical analysis is what these chartists are doing. They draw the charts based on past data, past price information. They look at the various patterns arising out of these charts, these graphs, and then interpret them. So there you may be able to judge what is the level, correct level or good level to buy or sell, or what should be the timing. So timing part can be taken care of by technical analysis, while with security, that part can be taken care of by fundamental analysis. So these are the two things. Apart from this, now if I use fundamental analysis, let's say for example, I may have to analyze maybe like Indian market. If I talk about, we have if I consider just CNX 500 stocks, there are 500 stocks. If I consider all companies which were even in past and present ingredients of CNX 500, maybe I'll come at what, 700 to 800 stocks. Now if I want to study all these 700 to 800 stocks in nutshell, must be very difficult for me as an individual. So how do I do that? If I have to shortlist good scripts out of this 700 to 800 stocks, forget 700 to 800, let's say you are given individually 100 stocks to analyze. You cannot analyze all quantitative and qualitative factors about all these stocks. Or at least once if you do it, you cannot keep track of it after investing your money into it. So how do we do it? We need something else? Yeah. What they do is practically, there's one more word which has come up in recent past is quantitative analysis. Quantitative analysis uses a lot of quantities, of course, fed into a computer software, and the software then shortlists looking at the criteria. Like my criteria could be a particular level of P ratio, my criteria could be looking at the profitability, then looking at the risk factors of the company, and then looking at the growth prospects of the company. So I will name my criteria and plug into software, and the software, or using some methodology, I will shortlist the stocks all using some technique. So this is screening or quantitative analysis. This is how also you can do the security analysis. So I do security analysis and I try to be smart enough, a smart fund manager, and I try to earn, I would try to beat the market. Market means some indices or the broad market, overall average return that people are earning without much expertise. So the fund managers, what they try to do is they try to beat the market, or they try to earn extraordinary return. That's why they earn, that's how they earn. But again, there is another category of people who believe in efficient market theory, EMH, efficient markets. They believe, if I summarize this concept, or if for the uninitiated, I can say efficient markets is you cannot beat the overall market, or you cannot earn extraordinary returns in spite of using any security analysis or fundamental or technical analysis, or using the past, present, or any kind of data, unless and until I have some private information, some secret information which is coming directly from the company to me. But again, this private information, so this private information is one way in which I can earn more than anybody else can make in the market. Yeah, I can use it. But the question is, will the government permit me? Will SEBI allow me? So legality is one problem. Second is, of course, it will have its own cost. Getting this private information will have its implicit cost. So is this cost more less than the benefit which I will get by private information, or it is more than that? So that is again a question. So private information, we don't know whether and how successful people having private information are. So efficient market people are saying, no, this is not possible. You cannot earn extraordinary returns. You do passive investment, just invest into the index, maybe Nifty, maybe Sensex. You create a portfolio. This is passive portfolio. Again, fund managers do this also. So it's futile attempt to outperform the market. So that's so there are different views. Some people believe in efficient market theory, some people believe no, we are smart enough, we have a strategy, a secret strategy, or maybe a public strategy, and we believe that there are some imperfections in the market. Which is why we can beat the market. So anyways, you get convinced or not, you believe in it or not, but you cannot ignore this because this is a huge fund industry which is there, existing there globally, not just in India. So it's a huge fund industry, mutual fund, ETFs, and we have pension funds, and then we have endowment funds also, so like that. So anyways, so this is stock selection. People believe, there are people who every day come to TV channels and they claim to have extraordinary abilities of stock picking. How successful? It's a question. Well, the next level comes is, after asset allocation, the broad allocation of money between various categories of assets. What we do is, within the asset class, let's say within equity asset class, you decide what securities to invest into. Now the next question comes is, when to invest and how much, at what price to enter a particular security, and what price would you exit a particular security. That is the main execution part. So the next part is trade execution. Here there are two variables. One is size of the trade, and second is execution of the trade. These two things mainly depend upon the market microstructure. You have to see what market you are operating into, what country you are into, how is the legal framework, or how is the framework of the exchange, what are the ways the exchange is operating. So one thing which you look at is transaction cost or your trading cost, that is like your brokerage and all, plus bid ask spread you have to see. Apart from this, you also have to see, suppose if I want to grab a big chunk of a particular company's shares, just because I am buying a big chunk, the price is affected. Just by the news that a particular fund is making a buy transaction, a huge buy transaction, yes, the price will be affected. because I am buying a big chunk of that particular company's share. So just because of my trade, I am impacting the price. Now this is called impact cost. So I will have to see for the security which I am trading, what is the impact cost? How much can I trade in bulk or in block deal without affecting? How much can I trade in a big deal without impacting the price in question, because I am targeting the current price structure which I am impacting in a way. So I will have to see the impact cost, transaction cost, and the third thing is, more I churn my portfolio, more will be the cost of maintaining the portfolio. So I cannot day in and day out, I cannot keep changing or churning my portfolio. I cannot keep rotating the stocks in my portfolio every day in and day out, as just like the fashions come and go. You change the your wardrobe. So similarly, you cannot afford to change your portfolio, right? Because that is not dependent on fashion. So that also has to be considered. How frequently would you like to churn your portfolio? That again is a question. So this is trade execution part, and for that generally there is a separate department in the fund houses. And the last part, let me come to that also. This is like a post-mortem. You here, after the fund has done everything, like after the fund decided at a broad category of assets it wants to invest into, using some strategy. After that, within the asset class, what you do is you allocate the money to particular securities, and then after you execute this strategy. Now after a period of time, or after periodically, sometimes quarterly or semi-annually or as well as annually, every time you look at the portfolio now, see how much is the performance in terms of pure return, performance in the sense risk adjusted performance, that is looking at the risk, what is the return which I am generating, how much is alpha, alpha is the extraordinary return measured to understand the stock picking ability of the fund manager. So how much is the alpha I am generating, timing abilities, how good was the timing to enter the market, how good was the timing to exit the market, so timing part of it, and then stock selection abilities. Now while doing this, I can also do attribution analysis. What is attribution? Attribution means this extraordinary return or alpha is generated because of what reasons? Is it because of timing, or is it because of stock selection abilities? So what is more important in what I have been successful into? I have been successful in timing part of it or selection part of it. So that attribution analysis can be done, and then probably this is a cyclical procedure, because these inputs for the next, this becomes an input for the next period. So here we end this topic of the investment process in portfolio management, and later on we will see further into this. So we are done here. Now hope you enjoyed.